All right, so most of us look at volume in some form or other in trading, and it makes sense because volume is really what makes the markets move. And if you're watching volume, you have a kind of a feel for the liquidity of the market. And we're going to talk about that a little bit more. So it occurred to me that, I keep talking about these upthrust bars and these, climax bars and things like that, but I haven't really discussed climatic volume before. So I thought I would, and kind of expand on some of the information I've already given you guys in the past. Let's see. Okay, so we got to do the risk disclosure. This basically says don't listen to anything I say. Everything I say is a lie. Be suspicious of anything and everybody that's trying to take your money. Don't trade futures because you're probably going to lose your money. So that's what they want us to say. Just understand that this is all for education purposes and not to be considered something that you would want to use to jump in and quit your job and try to make a living at. Okay, so hold on just a second. Okay, so if you go onto YouTube, this is going to be expanding on a video that we did on YouTube. And so if you go to YouTube to find this video, just type in volume spread analysis, and up's going to pop. The very first video on the list is going to be our video that we did a few years ago. And what you need to do is go ahead, and when you're there and you're watching this video, you can go ahead and hit subscribe. And this is new to me. There's a bell over there on the right side after you subscribe. There's a bell. And if you click the bell, you'll then get email notifications whenever we post up a new video, which we do regularly. So make sure you click that bell and you'll get a chance to see everything that we post. All right, another quick thing, we've got an event this weekend. A lot of what I'm talking about today, in fact, all of what I'm talking about today has to do with climatic volume, has to do with the climax bars and all of that. It doesn't have really anything to do with our indicators or our trade setups or the systems that we trade. It really doesn't have much to do with that specifically. But I'm going to take the information that we learn over today, and I'm going to apply it to trading. Climactic. I know, climactic. I have a hard time with Connor's in the background telling me to say climactic, not climatic. That's weather. We're not trading the weather. We haven't started doing that yet. Interesting thing though, there is as many influences on the weather as there are in trading. So even though you think you can forecast and that you could be 100% right, you absolutely can't in weather or trading. So there's the tie-in there. Okay, so if some of you will indulge me, I hope you will. I know a lot of you are experienced traders. A lot of you really, this is kind of elementary for some of you. So I hope you indulge those that are maybe kind of new to trading and maybe don't know as much as you do. So we're going to cover a couple of things very quickly, some basics, and what is volume. And even though, you know what, funny thing is sometimes you think you know an answer to something that seems very, very basic, but and come to find out you really didn't know it as well as you thought you did. So maybe some of you, even you experienced traders, will pick up something here. The volume is the number of shares or contracts for futures traders traded in a security of an entire market during a given period of time. Okay, so this is an exchange of a contract or a stock or whatever from a buyer to a seller. There's always, for every buyer, there's a seller, and vice versa. Okay, these transactions are what total volume is made up of. These transactions are the most important part of trying to understand what's going on in the markets. Orders are something totally different. When we talk about order flow, or we're talking about our depth of volume of market, or we're looking at our level 2 indicator, those are orders that may or may not become processed transactions. Okay, so each time there's an agreement between a buyer and a seller on price, there's a transaction, and that is volume of 1. Okay, so if there's only 5 transactions that occur in a day, the volume is 5. Okay, so that's what we mean when we're saying volume, and a very typical volume indicator is going to be something that looks like this. It's one of the oldest and most used technical indicators in trading. Typically, it's used to help assess the health of a prevailing trend. Okay, it makes sense that we track volume, because without it, we don't really have anything to do, right? Order analysis can be tricky, as orders don't have to get filled, right? They, like transacted, and can be removed. So if you're trying to trade off of what you're seeing on your depth of market or your level 2 stuff, there's a lot of games that get played in that. So we want to really look at volume because it's the actual. Okay, people try to trade the orders because they're trying to get a jump ahead of the actual transacted volume. They're trying to see what kind of volume might be happening or might happen in just a few minutes. Okay, so they're trying to get a jump. So let's look inside this just a little bit. Each one of these bars down here at the bottom is a quantity. Okay, and so this is on a scale. This is a histogram, and it's on a scale. So we're looking at how many transactions, so how much volume did it take to build or create this bar. Okay, so that's very important to understand that all of these bars coincide with a bar up here. Okay, and so you can generally get an idea. Now the colors, red and green, simply tell you whether the bar is closed up or down for the most part. Depends on which volume indicator you're using. But it should tell you whether you have more volume in the sales volume, or buying volume. Okay. Now, the analysis of volume gives us a general picture. General, and I say general. If we had very specific pictures, then it makes things a whole lot easier, and we've developed ways to get very specific pictures. So even though volume is considered a technical analysis indicator, which is what we do, right? Which is what most of us do when we use indicators on our charts, then we become technical analysis traders. Okay, most fundamental traders who look at the background strengths of a company and what it's got coming up, and these are fundamental investors. They also take note of volume for the same reasons that we do. If you don't have volume in an instrument, then who's going to be able to buy or sell when it comes time for you to do a transaction. Okay, so this is called liquidity. With higher volume, the assumption is that the instrument will also be more liquid, and when it comes time to trade, your trade is you will have lots of people to trade with, and you're not going to be stuck. Okay, now Richard Wyckoff. Richard Wyckoff was a very successful trader right around the turn of the 20th century. He became a market authority. He founded and edited a couple of magazines. I think they're kind of still around, but they've been renamed. He also became first he was a very successful trader, and of course once you're a successful trader, then people want to be taught what you know. And so he really made a study of the markets. And according to Wyckoff, the market can be understood and anticipated through detailed analysis of supply and demand. Okay, the same thing that drives the markets that we like, oil, gas, all of that we use every day, is driving the markets that we trade. Okay, it's all about supply and demand, which can be ascertained from studying price action, volume, and time. Okay, which gets me back to, I have a lot of people ask me, hey, can you use these on Renko charts? Can you use these on Heikin-Ashi charts? Can you? And I'm like, yeah, but why? Time is a very critical factor in trading. And it always has been, and it always will be. Wyckoff is the father of volume spread analysis, which is that video that I was talking to you about earlier, that you could go on YouTube and look at. And that's going to be most of what we're talking about here today, or at least the basis of it. Volume spread analysis is a good way to understand how the concepts of supply and demand influence prices. Okay, it allows for spotting those imbalances between the buyers and sellers by looking at price and volume. So through the analysis of volume, you can know if the market makers are buying or selling or taking advantage of your position. All right. So we're going to look at this, and you may see this looking like something that I've talked about before, but I'm backing up a little bit and taking this a little bit slower as it relates. I'm not saying I'm dumbing it down, but I'm just making it maybe a little bit easier to understand. So accumulation is the phase of the Wyckoff Price Cycle. That's the preparation for the next phase, which is called the markup phase. Okay, so when you see accumulation, what's happening is it pronounced Wyckoff? Huh, I've always heard it Wyckoff. Interesting. Okay. This is going to be one of those words, because I've been saying it that way for so many years that I'll probably keep saying that. So the accumulation phase of the price cycle is when the market makers are looking into an oversold, when there is a potential potential good point to buy supply, when there is very low demand, meaning that prices are very low. Okay, so but there is quite a bit of supply, so they're going to go about buying up as much as they can at this low price. Okay, so this is the accumulation phase. That's why it's called accumulation. It's when the big guys, the big boys, are going about it very quietly, very stealthily, buying up as much as they can at these low prices. Okay, the markup phase is that when the demand starts increasing, lowering the supply, right? So the demand starts to increase, more people start to buy, supply starts to drop. What happens to price when that happens? Price starts driving up, right? This is the markup phase. Then they have the next phase, which is the distribution phase. This is where the profits are made. Okay, so they're going to buy low, sell high, right? At least that's the price cycle for the market makers. Okay, so and then we're going to hit the markdown phase. And again, it's the same thing. The markdown phase, the demand is decreasing, supply is increasing, thus driving down prices, right? It's all very simple. This that we're seeing in the markets is a very simple cycle. And if you go and open a chart, you look at any chart, you're not going to see something that looks like this, but you are going to see something, you know, this nice, smooth, curvy line. You are going to probably see something that looks more like this. All right, but there's something missing here. Okay, in this nice, smooth curve that we used to define what was going on back in the early 20th century. Okay, the very simple accumulation, markup, distribution, markdown was a very simple concept to understand. But something is missing for us. What is it? Now remember, back in the early 1900s, when Wyckoff was a trader, author, educator, this was leading edge. This was how they knew what other traders were doing. This was how markets were manipulated with this information. It was called ticker tape for those of you too young to know. Have things changed a little since then? Maybe just a little. So there's another, need to be louder. Oh, how's that? Is that better? Sorry, my microphone kind of drifted to the side. Okay. So there's another phase in this cycle that what has been allowed to be created because of technology. Okay. So it's not enough to just manipulate a market to make profits. Now the smart money is going to do it so that they can set themselves up to do it over and over and over again, right? They don't want to just make the money and then wait for the markets to come back in their favor so they can do it again. They're going to force the markets back in their favor so they can do it again. All right, so no more nice smooth line. So we've got our accumulation, our markup phase, our distribution phase, followed by a climactic volume phase, and then the markdown phase. So this is an entirely new part of this cycle that has been created because of technology. So this is what it's going to look like on an actual chart. Okay, so we have an accumulation phase going on here. We actually have in the next level up another phase that's actually called reaccumulation. So they're going to do it, and then they'll probably do it again up here, and then we'll come up here and we'll distribute, or we're going to sell all the inventory that we bought down here. Okay, and this is where all the profits are being made. Now, they're going to do that with just enough contracts to hit whatever goal they have for that, but they're still going to be the major holder of this particular instrument. Okay, so they still have, it used to be at this point they would just distribute all of their inventory, and this was where all the profits got made. But instead, now they do something a little bit different. Okay? They're going to run price up through, and we'll talk about how this is done. And then on the way up, they're going to start dumping off all their contracts. Okay? All of them. So that the supply will now overwhelm the demand up here. And what happens when supply overwhelms demand? Price plummets, right? Go look at a trading chart, a time-based trading chart. You're going to see this happening over and over and over again. And it doesn't just happen in this, you might get several of these accumulation and distribution before we get this final big push and a pullback here. Okay? So on the final manipulation, you're typically going to see some climactic volume inside this bar, because this is where we're going to get that big offloading from the asset holders here. They're going to just dump everything on the market, and we're going to get this big spike right here. So if we put on a volume indicator, you'll notice that the volume is a lot higher than these previous bars. Now, something I wanted to bring to your attention. Most people believe that big volumes or big moves are caused by big volume. But if you look carefully, you'll notice the red bar on the right is only about half the volume, but the bar itself is longer. So you don't have to have huge amounts of volume to have big moves, and vice versa. So you want to keep an eye out on when the big volume actually does create a big move. So how much volume is considered climactic? So the first thing we're going to do to determine that is we're going to look at a look back period. And for this example, we're going to look back, and we're going to look at 10 of these histogram bars. And we're going to take the value of each of those histogram bars. We're going to add them together, divide by 10. Okay? And so we're going to come up with an average volume of the last X bars. And this is 10 bars here. So you can consider climactic volume is going to be at least 200% of the average volume of the last X bars or so. You could always change that to 15, 20 bars, whatever it is, however you want to measure that, and generate a bar that would be considered climactic. Okay? But big moves do not always mean big volume. Big moves meaning like a big candlestick, meaning price moves a long way in a short period of time over maybe just one bar. Okay? That can be done and is done a lot on lower volume bars. Bars that are not considered climactic. Okay? So we would say that this bar is climactic because it is more than double the average of the last X number of bars. Okay? Any questions on any of this so far? You guys have been very quiet so far. Promise you there is more information coming about how to trade this, and we're going to be covering that on Saturday. But it's really good to have this background information so that you'll have a much better understanding of what we're going to talk about on Saturday. Okay, so that means you guys are all ready, that you got this, you understand, and you're ready to start trading climactic volume, right? Well, let's wait just a minute. There's a bit more we need to understand. Okay, but it's coming. So we get this big bar, right? And we now know that that's created by climactic volume. But what's causing that big bar? Why would that happen? What is actually causing that? Besides the dumping off of volume, momentum traders cause that. There is a whole group of traders, and there's a whole group of these market big shots and market manipulators and HFTs and quants and hedge funds that have all this money and all of this equipment to be able to do this. And what they do is they're called momentum traders. And momentum is all relative, right? It's not a fixed amount or a percentage of the market. It's relative to the recent past conditions in the market. So momentum traders will take advantage of a trend. They trade from level to level inside a trend. And momentum traders are trying to capture a strong move based on aggressive buying and selling, bidding up a price or down by overwhelming one side of the bid-ask spread and setting up a strong move in one direction, usually temporarily over a short time period. Okay, so we've got these momentum traders are jumping in on these bars. Now, the thing about momentum traders, they're not buy low, sell high kind of people. They're buy high, sell higher type of people. So what they're looking for is inside that what we're looking for is a momentum traders. They're looking for these areas where they look like either accumulation or distribution. And then they're going to look for an average and then a breakout from that average. Okay, so you can see that we had a breakout of, actually it was probably down here somewhere, but we had a breakout. All right, once price breaks out of this channel, that can trigger the momentum buyers. Here's how this works. It's ridiculously simple. What they want to see is price breakout, and this is where they're gonna buy. Let me look at the next slide and make sure. Yeah, let's look at this inside this one. All right, so price is channeling. Could be low interest, could be accumulation, could be distribution, doesn't really matter. But price is channeling. The buying sentiment increasing with a lot of sudden bidding up of price. Okay, momentum traders now get triggered to buy up as much as they can, as fast as they can, causing a sudden shortage, driving up prices even higher over the short term. Okay, and again, this is all because of the electronic markets now, right? So buyers begin to become, at least on a shorter time frame. All right, so buyers begin to become exhausted. Momentum traders then dump everything as fast as they can before all the buyers are gone. Okay, this is where we also see a contribution to that climactic volume. Okay, those momentum traders are running up price. When they do that and then dump everything, the sudden oversupply drives prices down. So they want to get out while, up in here, while there's still enough buyers in the market. Well, because we're a bunch of idiot retailers, we're those buyers. And we see this strong move and we go, oh, I don't want to get left out. Look at that. I'm going to buy. And so you might see price here, and we call this freight training in the trade room. Might see price here, all this everything's getting dumped on here, but there's still buyers in the market. The fear of missing out buyers that want to jump in on this big move that's going on here because they think it's going to go on and on and on. They feel like, well, I've already been left behind. This is the big breakout. I'm going to go with it, and then sure enough, they get trapped and price drops. Okay, so this gave me an idea. This is what started the whole thing that we're trading now and have been for 10 years now. So I started looking at this and I started thinking, you know, I need to study this. I'm going to look at this phenomenon and I'm going to look at just millions of data occurrences of this same thing. And it's so easy to find because all you got to do is pull up a chart, any chart, a time-based chart. It's easier to see on minute charts. You can see it on tick charts, but you see it over and over and over and over again, so much so that it becomes a regular pattern that is very predictable. Now, it's overlooked a lot because it's not a tremendous advantage in and of itself as far as the amount of money that can be made. But it happens so often that it's one of the easiest trades to get good at. So I started looking at these data points so that I could anticipate when that pullback happens, when that sell-off happens. All right, I want to be in on it at the beginning. I want to know when it happens. I'm not going to be one of the ones to jump in for fear of missing out. I'm just going to wait until all the conditions exist for this little pullback right here. That's it. That's all I want. I call this my sweet spot right here, this little piece. Usually that's overlooked because traders are looking for a great big trend to get in on. Okay, I tried that. It didn't work out for me too well. So here's the conclusion. And again, we'll go over this, but on a chart this time. Momentum traders have caused an unnatural increase in buying sentiment. From when I say unnatural, this is what it was. And then suddenly, nothing happened, right? There's no news event that suddenly had price breaking out of this channel, right? It's just people. And of course now machines that are programmed by people. But nothing specific happened here that influenced the markets directly to cause this. So what it is the momentum traders have caused this unnatural jump and caused this the strong increase in price. And I say at a relative, again, it's all relative. So price now gets up in here where the buyers have bid it up, and this is where they start getting rid of it. All right. And then the prices continue on, and they continue on because the retail traders start freight training. I don't want to get left out. Exhaustion sets in, and momentum has already started. Even though price is going up, these guys sold down here, and so momentum sold in here. So momentum has actually shifted around in here, but we get this freight training effect because of the retail buyers that don't want to get left behind, and they're the suckers that are buying up all of these guys. I say they are. We are the suckers that buy up all of these, pushing the price even higher before there are no more buyers. There are no more buyers up in here. and then exhaustion sets in. Momentum has already changed directions. All right, so after doing all the analysis, this is what that looks like. This is what we trade. Okay, on our trading charts, all of that information I just showed you is right there in front of us to make a trade decision right here. So for us, that trade decision would be on the open of this bar, we would put on a short, or somewhere up in here. We would short this. Okay, you ready? You got it? You ready to start trading climatic volume now? But wait, there's more. So here's the deal with that. You can't just trade off of momentum traders. You can't just trade climatic volume. Oh, I misspelled it on that one. Those are just for giving you a heads up that there's a good opportunity for something specific to happen. Okay, so what we do is we couple this information with other very strong information. Divergence. Remember I said that momentum had changed directions. Divergence is what that is. So even though price was climbing, momentum was actually going the other way, had already changed directions. And we have the best divergence indicator on the market to help us pick up exactly when that happens. All right, so we want a heads up that we have the climatic volume, that we have the momentum traders are now jumping in. Then we also want to know, do we have a divergent condition? Are the rate of processed orders so fast that it is impossible for those orders to be placed that fast by retail traders? Okay, us retail traders are sitting at home on our wireless Wi-Fi, on our laptops, trying to trade, and we're trading just a few contracts at a time. The big boys are using those big supercomputers, and even though they try to hide their tracks by not trading huge numbers at one time, they still break those orders up. But in order to get them in and manipulate the market, they're going to try to place them very quickly, one after another, in milliseconds. Okay, so they're still trying to hide by breaking up their orders. But if we read the rate of processed orders, this is called our speed tick indicator, then we have a real good idea when this is happening, when these markets are being manipulated, and what's likely to happen next. So we've got to look for strength in downtrends. We got to look for weaknesses in uptrends. We have indicators to do that. We of course use support and resistance, and as I mentioned, we're very interested in climatic volume, but we also use that information in our volume spread analysis indicator, our pullback alert, because we don't want to know about all volume or all climactic volume. We want to know about the right kind of climactic volume, and I'm going to talk about that on Saturday. Okay, we want to know, because you can have a bar and you can say, yes, that bar was built by climactic volume, but you don't know how the volume came into that bar. That is of critical importance to know when that bar is likely to be exhausted. Okay, or if price is going to continue to push. Okay, So now we're not just, looking at one or two things. We're looking at a whole bunch of stuff, to the point where if we have an agreement among all of these things, a trade setup is not only likely, but most likely it's imminent. It's coming. It's going to happen. All right, if all of these things are in place. So we call this confluence, right? So let's use an analogy here. Let's say you're in a group of professionals that are all experts in a different particular field, but maybe they're all talking about the same thing in general. So maybe, I don't know, it's global warming or something. And you can get all of these professionals from different fields using different data to come together and agree on one thing. Okay? Would you find that compelling? And I take that logic and I apply that to our indicators and our trading system. Okay? So we've got all of these different indicators, which we'll talk about on Saturday, in agreement with each other that something is likely to happen. And that something is this pullback right here. Okay? So we're looking at this push. We're looking at this pullback alert, which is what I was telling you. This is the indicator that says, yes, it's climatic volume, but more importantly, the orders came in such a way that it's very likely this bar is exhausted. Okay, so we print it right on the bar when it happens. This bar opens with this rock star, and down it goes. Okay, I'm going to show you how to trade this on Saturday. Now, we've taken the best of those three, of this confluence. So we've taken our speed tick, our OBOS indicator, and our super divergence indicator, combine them into a single signal and we call that our rock star indicator. We have this, we've been trading with these three indicators for many years. And I was very comfortable with this. But people kept missing setup, getting confused because there's three things to think about here. So I thought, you know what, let me just combine them all into one indicator. And when all of these conditions are met, we'll print a rock star on the open of this bar. Man, this rock star indicator, even though I thought it wasn't necessary, it has really shifted gears for a lot of people in their trading. Okay, so let me, so that you can see what it is that I'm talking about here. Let me do it. For those of you that have not seen our trading system, let me show you a few of our setups. I'm just going to drag this real quick. All right. This is our momentum indicator. See this hard push? This crazy hard push, right? This is what we want to see. Strong momentum. This bar is getting lighter gray than these black bars because the momentum is increasing and the exhaustion is becoming more imminent. We have a pullback alert on this bar saying this is probably a climax bar, and the price action inside this bar is such that it's very likely this bar is going to pull back. Then we have our speed tick indicator. This is telling us that the orders being processed are being processed so fast, it's very unlikely they're being processed by retail traders. Okay? This bar opens. Notice where the Rockstar prints on the open of the bar. So you make a decision right then. And that's it. That's all I want right there. This little pullback right here is all I want. And it happens over and over and over again. All right, same thing. Breaking out of a channel, jumping up, overbought, speed tick, pullback alert, open of the bar, Rockstar. This is where we place our trade right here. Same thing. We keep doing it over and over and over again. And the interesting thing is we have people come into the trade room. Maybe you want to do a trial of our trade room after seeing an event like this. And this is exactly what you see. This is not, I used to go to webinars when I was a struggling trader, and then I'd go in the trade room, and it wasn't anything like what I saw in the webinar. But this is exactly what we do every day, day in, day out for the last 10 years. Price pushes up, overbought, Rockstar, down it went. See how price keeps pushing here. Get oversold, speed tick, pullback alert, oversold, speed tick, pull. We still haven't traded yet, right? Just because we have conditions that exist does not make it a trading opportunity until we have a full confluence of events. That's where the Rockstar kicked in. So we didn't trade this bar, we didn't trade this bar, we didn't trade this bar. We had our little pullback right there, which was a winning trade. All right. Then it took off, did it again. Anyway, you get the idea. We'll go over this more on Saturday. All right, so there's the link for Saturday. Connor put that link in the chat so you can click on that. Or if you're watching this on video, you can pause it and type that in. And we do have some specials for you. All right. We've got the Rockstar special where you can save 75 bucks, and we're going to give you a week in the trade room. We have a package called Academic. We actually have a lot of packages, and we do that because people want to kind of get started. Sometimes people want to jump right in, and they're ready to commit and get really busy into learning this. This is our Einstein package over here. We have a lot of Einstein. Eventually, most of our traders either get in to the Einstein or upgrade to the Einstein because we add, pretty much this is a one and done thing. Once you're in Einstein, you get everything that we have. You get everything that we ever develop in the future as it relates to indicators. We have a new peer mentoring program that's starting soon. We have other tools, NinjaTrader tools that we give you. We have a training program that we give you. We have a weekly mentoring events. We give you everything that we can think of if you're an Einstein investor, and so we're putting that on special until Wednesday. So you can go down here to our website and check that out. Are there any questions for me? Oh, use the coupon FIRST5. If a coupon code FIRST5 if you're one of the early birds, and you'll get even more of a discount. Oh, I did have another. Yeah, there was another one. You guys have any questions? I see someone typing. We trade the in our trade room. We have the ES, the RTY. This is all futures. The NQ, the YM, the CL, and the GC. I personally prefer the YM and NQ. I used to prefer the CL and the GC, but they don't move as well as they used to. And the YM and the NQ, which are the less expensive instruments to trade, they're only $5. They're the ones that actually move the best nowadays. All right. Well, I want to thank you all for joining us here today. Hopefully, you can make it on Saturday when we'll kind of get where the rubber meets the road kind of thing. I wanted to give you this background information so that when we meet on Saturday, you're all up to speed on what's going on, and then you can just jump right into the trading part of it. So come visit with us on Saturday morning, and until then, have a great rest of your evening. Have a good Friday, and if I don't see you Saturday, have a great weekend. All right, everybody. Take care now. Bye.